So before you go through this particular recording, you should go through one which should be titled Looking at a Mutual Fund in Yahoo Finance. That is the prelude to this particular recording. So this recording will make a lot more sense if you have listened to the other one. Otherwise, I wanted to keep it into two modules. Otherwise, the modules may get too large. So that was really the module one. Please listen to that one and then listen to this one. So here I'm going to do is to kind of walk you through the answers for the questions, and but it really connects to the conversation I had before. Okay, so this again will some of the stuff will not make sense if you have not heard the other one. So let's go through it. The first question was to understand basically, what are different kinds of funds. Stock fund. A stock fund is a mutual fund or an ETF, some kind of a fund, which has basically all stocks. There's no bonds in there, and it's called a stock fund. Now, within the stock fund, you can have a value fund, which means all the stocks are going to be large companies. You can have a value growth fund, which means there may be some companies that are large, but potentially investors think there is some growth opportunity. Could be a small cap fund, which means, again, all stocks, but it's going to be smaller companies. Could be a fund that is targeted to a industry, which means it's still all stocks, but could be all be financials like banks and insurance company. Could be a fund that could be an energy fund. That means it is all stocks, but could be energy companies like ExxonMobil, Apache, and other energy company. Bond fund is basically a fund that only has bonds. That means it could have corporate bonds, it could have government bonds, it could have municipal bonds, but it's all bond funds, and they're all bonds in there. The large blended or target fund basically means that now you have a combination of both stocks and bonds. So in the prior lecture that I just mentioned, you should listen to it. I went through two of the funds that are listed below. We went through in the other tutorial, I went through this fund and I went through this fund and showed you where you find all this information that is required over here. But more important, I made some commentary on what all this stuff means. Okay, so in the case of this is an example of a stock fund because all it had was 100% in stocks. This is a blended fund because it has both stocks and bond. This is a large growth, but it's all stock fund. Okay. So we got the data from Yahoo Finance. In the other tutorial that I just mentioned, I went through and showed you where all this data comes from. So I think you should go obviously listen to that. And also really important, and even if you know where you got the data from, I think it is important to listen so at least you can hear some of my commentary where what does some of this data mean, and how does one use it from an investment strategy perspective. Okay, so here are the answers for the data. Again, I asked you to go look at it from the Yahoo fund. The Morningstar box, this one is a large value fund, as you saw. This is a large blend fund. This is a large growth fund. 10-year growth rate 8.1%, 5.5%, 7.5%. Load, which means is there any commission upfront when you buy the fund? And all these are no load funds. Expense ratio, which means what percent of the money they take it. This one is 0.29%. That means whatever the value of the fund will be that year, they will take 0.29% of that. This is the fee for them to manage the fund. This one is 0.14% and 0.54%, and that is typically low. It's less than 0.5%. That is acceptable. If I look at the return on the net, which means if I take 8.1% and subtract 0.29%, we basically are left with 7.8%, 5.38%, and 7.03%. And again, we are looking at a 10-year, and again, if you want to look at the 5-year and 3-year data, that's also available, but I asked you to look at a 10-year. Here it shows you what is in the fund. Obviously, the first one is all stock fund, so it's obviously mostly stock. This one is a hybrid, but it is some stock, mostly bonds. This one is again all stock fund. Turnover, this this turns, there's more turnover going on, and this is really not that important turnover really, but that's just information. This turns less. It's 40%. Typically, bond funds do not have large turnover. Expenses, as mentioned above, again same number, 0.14, 0.29, 0.14, 0.54. And the beta, as I discussed what beta was in the last lecture, and I think in order to understand what this means, please go listen to that. Again, the beta is a measure of how this fund, on average, is changing compared to the S&P 500. And you can see these two funds, on average, one means basically on average it is moving at a similar pace as the S&P 500. And again, I discuss in more detail, but quick summary. If you are comparing the S&P 500 growth versus the fund, whatever the fund it is, and we're basically looking to see if, as this fund is growing and comparing it to S&P 500, how does the data look? This goes up this percent, this goes up this percent, and when we draw the line, that kind of gives you the slope, which is called the beta. So the beta of 1 basically means on average this particular fund, these two, at least on the extreme ends, have moved at about the same pace as S&P 500. Whereas the middle fund is moved less, and you would expect that because it has less stock in there, and obviously S&P 500 is all stocks, so it has done, so the slope will look more like this. Now, why is that important? That means that if you want to have some, your asset allocation basically does is to provide some buffers. The stock market drops a lot. Again, this fund, these two funds basically are going to drop as much as your average market is dropping, whereas this fund will drop less. Why? Because it has got a smaller beta. Okay. And again, please listen to the other recording. Standard deviation, we talked about it in detail in the other one. Basically, that means is this particular fund on average, how does it move? What is the variability among it? Typically going to find stock funds to have a much higher standard deviation. So between these two funds, basically everything else is the same. It has got the same beta. Actually, so if I had to compare this fund with this fund, looking at all the data, I would give a higher score to this fund than this fund. Why? Because it is providing, the first one is providing a much better return, slightly better return. The beta is the same, and the standard deviation is a little bit better. Okay. So again, I kind of touched on what is beta and what is standard deviation, and which is better, which is not, in the other tutorial. So I think you should listen to it. Now, in reference to number 2 and the standard deviation, return versus allocation, and I kind of touched on it, but let me just quickly go through it one more time. So you can see that the fund in the middle is slightly different. And if the intention for that fund is for somebody to have some, some buffer, so the portfolio does not move a lot, you basically are going to have a fund that has some, bonds in there. Okay, but overall, it obviously did not go up as high compared to these two funds, which did, over 7%. But the beta is less, which means if you're worried about stock market dropping, this fund may probably not drop as much as these two funds will. And again, on the standard deviation, standard deviation, the lower the standard deviation, that means that the fund overall variability is less. So what does that all mean now? What that means is that if you were deciding to have some portion of your portfolio, again, we'll talk about more portfolio management in week 7 and week 8. But if you looked at all your funds in your IRA or some, whatever your investments are, and you looked at their beta and your standard deviation and the return, what you want to do ideally is to have a fund that if it's comparable, like these two funds are very comparable, they're both stock funds, etc., etc. But this has got a higher standard deviation, and this has got a lower standard deviation. So they're basically comparable compared to this one, but this lower standard deviation will mean that it will have a little bit less volatility. If it, again, this data is based on historical data, again, if it behaves the same way in the future. Okay. So return versus allocation, what does that mean? Means that overall in the long run, because the stock market has done better than the bonds, higher allocation of the stock has provided a higher return or percent in performance. Return versus standard deviation. Obviously, you would expect that a stock fund, which has got more variability, has done higher. So the funds on the left and the right have a higher return, but the standard deviations are high too. So the relationship typically is that higher return would translate into higher standard deviation or higher moves in the variability. And the last one, the return versus beta, that typically you're also going to find that the fund that have the more stock, they're obviously going to be correlated more to the stock, to the S&P 500. So you're expecting that the return will be comparable to the beta. So in this one, the beta was less, 0.44, and obviously you expected the return to be lower in that one too. So what would that mean as far as number 5? Which one would be better? And again, really depends on how person wants to plan. But overall, if you kind of take the textbook approach or the theory approach, somebody who is younger can afford market variability over the time. If he or she has got 30 years, let's say they want to retire at the age of 65, they have 35 years. So even the market goes up and down, overall it eventually kind of catches up, and it has over the time. But if you are older, and let's say you are here at age of 50, you have only 15 years to go. So as you get closer to your retirement, what you want to do is to make sure that your portfolio is balanced in the sense that it has, some cash and some safe bonds, and so as the market goes up and down, the portfolio standard deviation and the portfolio beta should be better than the S&P 500. What that translates into is that the volatility will be a lot less. Okay. So I gave you another Excel exercise to say what happens if you had those funds and you look at the data. And again, this we have done it many times. And again, the way you do it is that if I'm putting in 10,000, the reason I put it in the minus as you go through the Excel, but you're going to try to figure out what the future value is. The present value is the money that I'm putting in, which is minus 1,000. This is the present value. Okay. R comes from the return that the fund is giving, and the N is 10. And the present, so you calculate, you'll calculate, and using what you're going to do is you're calculating for rate. So when you're going in the Excel, you would find the formula that says rate, okay, and you're going to plug in the future value is going to be this number. You're calculating for the future value here. Sorry about that. You're calculating the future value, which is this number is going to come up. You're calculating for the future value. You're putting in the present value, and you're putting in the R, which is the percent that you're getting from the top. I also had you calculate the average compounded rate, which is over here. And the average compounded rate, which would be, we basically are going to solve for rate, R-A-T-E. And now the future value is 21, present value is minus 10, and N is 10, what you're going to get. And obviously you'll expect this number would be the same as what we know already. So kind of summarize this thing over here. If we put in the money and we use the return, that's what we would have. And if I did not know the rate of return, obviously I can calculate by using the rate data. Okay. Last one, I basically had you go through and compare two funds. Once you already talked about it on the top, or at least looked at the data. And now we're just comparing it with another fund from a different fund. So we did this one, which was done on the top. It was a large growth. Now I asked you to do is to compare it to another large growth fund. I just basically gave you a fund, which is the Fidelity FSC TX fund. This one, the growth rate, if you went through it, you found was 10.48%. And again, this one we already know 7.5%. Both of them have no load. This one has got a slightly higher expense ratio compared to this one. But if I compare it net of the expense ratio, this is still better. This is 9.74 and versus 7. If I put in 10,000 in 10 years, we will get this number. In this one, if I look at what is in the fund, is again they are both stock funds. So obviously 99% are stocks in there. Beta for this fund is 0.89 compared to this one is 1.03, which means that this fund on average is not as, if the stock market goes up and down, it has gone less up and down. Beta over the 10 years is, compared to the other funds, category basically means is, typical funds in the same category, they basically kind of move like the S&P 500. Standard deviation is 14 versus 19.68. Again, the category, which means these kinds of funds, typically standard deviation is 20 to 19.6 in this case. So what does that mean? The punchline on this one is compared to these two funds, fund on the left has done better overall in terms of return, even though the expense ratio is high, but it's done a little bit better. And the beta is lower and the standard deviation is lower. So compared to everything else, looking at this data, Fund A, FCNTX, has done better compared to the one on the right. And again, obviously we don't know what the future will be, but if this fund does as it has done in the past, then the fund on the left would be a better fund than the one on the right. So again, this is what we just talked about in number 9. Which fund is better? Fund on the left has a better return, and return versus the risk. Fund on the left has got better return, and especially comparing it to the risk, which is the standard deviation, and the beta has done better. So the Fund A on the fund on the left would be a better fund, at least looking at the data, historical data.